Okay, great. I think we're live. Hi, everyone. Thanks for joining tonight's session. This event is the 52nd in a series of Yale Career Panel and Yale Career Fireside Chat. To give you a brief context, the Yale Career Panel Committee has been formed by a few Yale alumni about 9 years ago. And since then, we've been featuring different professions, over 42 Yale Career Panel and 9 Yale Career Fireside Chat. And the purpose of our panel is to really provide a candid view on each of the different professions so that students and alums in the Yale community can make more informed career decisions going forward. So today we are featuring panelists from venture capital and private equity space. We have Elizabeth, who is a vice president at a private equity firm, Michael, who's a managing director at a family office that invests across venture capital and private equity, and James, a partner at an early stage venture capital firm. So hopefully we'll get a diverse perspective on this profession. We're gonna start with the questions, and at the end, we'll leave about 10 to 15 minutes for interactive Q&A. So for those who are attending, if you guys have any questions that come up in your mind, please use the chat box on the right side to enter any questions, and I'll pick them up at the end to answer those. And then as a reminder, after the panel ends at 7 p.m. Eastern, we're going to have a networking session for half an hour where you can meet and interact with other attendees as well as the panelists. Okay, so I think we can get started. So first question, what do you do? Let's start with Elizabeth, go to James, and then end with Michael.
Sure. So what do I do? A question my parents still ask me. So in a nutshell, I source businesses to invest in. I evaluate those businesses as potential investments, execute investments when we decide we like the opportunity and want to invest. This means working with advisors like consultants, lawyers, accountants, among many others. We draft legal agreements. We put together presentation materials for colleagues, talk to lenders for debt financing, again, among many other work streams. And then when all that's done and the dust settles, I then work with the companies that we acquire on various growth initiatives. And those are obviously specific to each company that we might buy. And this is actually where a lot of my time is spent, where a lot of time is spent in the industry. You don't hear as much about it. You hear about the deal, but a lot of time is then spent working with the companies over 3 to 5 years, typically, though it could be sooner, it could be later, again, depending on the investment. And then after 3 to 5 years, again, I work on selling the company either to another buyer or potentially taking it public. And then just quickly about my firm, and then I'll stop. But my firm, Stonecourt, has a flexible mandate. So while our bread and butter is a standard controlled private equity deal, standard LBO or leveraged buyout, we can do structured deals. We can take minority or majority positions depending on the opportunity. And while we're sector agnostic, we've been doing a lot in deep tech. We've been looking at crypto and blockchain lately. I also spend a lot of time in healthcare. And always, in particular, happy to work with fellow Yaleys. So stop there, but I'm sure we'll get into it in more detail.
Great. Michael.
Sure, happy to jump in. That's a tough act to follow. Elizabeth summed up investing pretty nicely. I think you could be done for the day, right? And thank you, by the way, Julie and Peter. It's great to be part of this panel. My role is very similar. So I run a family office. We are distinct from institutional investors in that we do have a broader mandate. We have a single LP, so it's one source of capital. But we invest similarly. We look for appropriate risk-adjusted bets in venture capital and private equity. Similar to Elizabeth, we are relatively stage agnostic. We pursue both venture capital at the early stage, seed, Series A, Series B, and also middle market buyout. And so that flexible mandate is certainly exciting and gives us the ability to go in different directions. And day to day is also very similar. So we originate deal flow. We evaluate those deals on its merits. We get to understand the management team. A lot of this is a people bet, especially in VC, but also in private equity. And then after we greenlight a deal and we pursue it, it's a lot of management and helping those companies and those management teams thrive. And as Elizabeth mentioned, in 3, 5, 7, sometimes 10 plus years, we then seek to exit and focus on helping to bring the company to its next buyer. And then the cycle continues. So I'll stop there, and I know we're going to get into the details later.
Yep. Thank you.
I guess I'm last. So very simply, I too invest in and support companies. For us, we invest in early stage ed tech. So early stage for us means seed and Series A. Our checks are usually $1 to $7 million. And ed tech sort of spans the full continuum of learning and human capital development, from cradle to career, as we call it, as well as some adjacent verticals like freelancer and creator economy, learning enablers like student mental health, student physical health, transportation, etc. And we're pretty agnostic as to the technology and business model.
Got it. So it sounds like all of you guys, the work that you guys do in a way, all invest in a business. But let's dig deeper into the difference between the venture capital and private equity. And some of our attendees may already know that, but a lot of people may not know the distinction. Anybody want to jump in and then describe the real difference between the VC and the PE space?
Yeah, I'm happy to take a first stab at that. There's no hard and fast rule, but I would say that thematically, venture capital are earlier stage companies where they're just getting going, they're growing. They might still be figuring out product market fit. They might be past that point and looking to scale up. They can be profitable, but oftentimes they're not. They have a burn. That's an investment in customer acquisition or in distribution of all sorts. And then private equity, oftentimes you might have a more mature business. Typically, they're cash flow positive, and so they trade differently. But I think a lot of it comes down to control. Oftentimes, venture capital investments allow investors to take a minority position. While they might have a board seat, they might have a say in the operations of the business and could be a really important partner to the management team. They don't control the outcome. They might have controls, but they don't ultimately control. Whereas with private equity, and again, every firm is different, and you could still be investing in private equity as a minority investor, but the traditional shops will then acquire the business, or at least 51% or more of the business, so that they have a little bit more of the ability to move the needle and set those companies in the direction that they feel is right. And oftentimes it also involves getting much more involved in the day-to-day operations and bringing in management teams if there's gaps. And I'd say the last piece is oftentimes hold time. You can imagine early stage companies, they have quite a bit more runway to get to that point where they've established themselves and achieved enough market share where they're viable for an acquisition. Oftentimes private equity, so that could be 5 to 10 years, and we have some investments that have held for more than that. Oftentimes in private equity, the horizon is perhaps 3 to 5 years. It could be even shorter than that, where there's a short-term arbitrage opportunity to improve operations or to go after new markets. But again, these are just general buckets. There's often tons of overlap, and you'll see firms doing all sorts of things that they might call venture capital, and others will call PE, and vice versa.
Yeah, I agree with that. I've spent time in the past at a pure venture firm, and I've been at pure private equity firms. So again, what Michael just said, like, we're making general statements here. Firms are all very different. The day-to-day of the job can be very different in a pure venture firm versus pure private equity. So one difference is cadence. So in venture, again, in general, you'll see more deals on a day-to-day basis. When I was in venture, I could see over 10 deals in a day, one after the other. In private equity, maybe one every few days or week, or maybe one big deal every few weeks. And then you can spend much more time on that deal. We've already talked about company maturity, how in venture you might be investing behind a team and a dream, whereas in private equity, these are much more mature businesses. You're looking at, years of historical financials, and that can lead to more technical analysis when you're at a private equity firm. You might have multiple tranches of debt. The analysis can be more rigorous, not better or worse. It's just much more quantitative, much more technical in nature. You're dealing with complex accounting, tax, et cetera. In venture, I think overall, the analysis can be more qualitative. You have a big picture view on markets, on trends, on overall industries. And that's why I'd also say from a recruiting perspective, which perhaps is of interest to some today, I would say the barriers to entry in general can be higher in private equity, in that there's a standard hiring process. You're usually, though not always, expected to have completed 2 years of investment banking or consulting. And that's related to the fact that it's just a more technical training that's required for private equity. Whereas I think you have more diverse backgrounds that that can be well suited to venture. And obviously, I'm sure many people know this, in venture, you're taking greater risk, right? You're looking at earlier stage opportunities. You'll put money into several deals. 1 or 2 of those might be a home run. Some might go to zero. In private equity, deals should not be going to zero. They can. That's not good. It's never good, particularly bad in private equity, where you could be I've seen $1 billion go into a company and it went bankrupt. Usually you don't put $1 billion into a venture deal, though we've seen it happen. But again, that's just another difference between the 2 areas.
I think my co-panelists have said most of it. 2 points to make. Technically, VC is a subset of PE. That is, you're investing in the equity of non-public companies. And indeed, that's how LPs, the investors in our funds, treat the category. It's like one asset class of private equity. The other thing I would say is usually, though not always, VCs are tech focused. They invest in tech companies or tech enabled companies, which tend to have higher margins and faster growth profiles. Whereas private equity, generally speaking, can invest in pretty much any industry.
So I know that you guys.
I'll just add to that real quick. James is right that is a generality, but I will say that every industry does have its nascent periods, and every company needs that early stage funding. For example, our office does a lot of consumer, so we do invest in early stage consumer brands. Of course, the scalability is much stronger with our tech investments, but there certainly is a world that's smaller. I think to James's point, that's non-tech, but certainly that is an active space within VC. So
it sounds like you guys mentioned a little bit of what you guys do on a daily basis. I know, Elizabeth, you mentioned that in order to be in a private equity space, you gotta have the technical analytical skills and maybe building a financial models, and still be able to maybe manage some of the portfolio company. And seems like Michael, James, maybe when you're looking at some of the venture capital role, you may be meeting more people, and those people could be on the younger generation, and people from more diverse background. So let's get into hear about your day-to-day basis work. I think this is very interesting especially for students who are about to launch into a new career. You can look at today's schedule or any typical day, just a very representative day of the week, and then tell us literally like from start of the work to the end of the work, what did you do? What do you do? Let's start with you, James.
Sure. I'm sure Michael and Elizabeth will agree. There's not really a typical day. It varies depending on time of the year and the activity and the pipeline needs of the companies, all that kind of stuff. But if I could assemble an imaginary representative day, it'd be like a few hours of portfolio company support. So like talent, fundraising, strategic conversations, things like that. A couple hours of due diligence on a live deal, which I'm usually on at least 1 or 2 at a given time. So that could be data analysis, model building, desk research, customer references, personal references, et cetera, et cetera. I'll probably take 1 or 2 new company pitches in a day. When I was earlier in my career, when I was more junior, that was much more, to Elizabeth's point. It could be like up to 10 to 15, but These days, it's usually one or two of the more promising ones. Probably take a couple meetings with important stakeholders in the ecosystem. So like our co-investors, potential acquirers of our companies, industry practitioners, etc. And then, I don't know, maybe like 30 minutes to an hour of just like internal stuff, miscellaneous, emailing, blah, blah, blah.
Sounds like a lot of meetings in your day.
There's a lot of meetings.
Yeah. Elizabeth, do you want to go next?
Sure. I imagine, not to speak for Michael, our answers will be similar. I mean, we've already discussed how we wear a number of different hats, from sourcing deals to executing on deals to managing them to selling to working with our portfolio companies. And therefore, no day is the same. You're doing one or more of those different things. So yeah, I don't have too much more to add, though I would also say you could easily, in addition to all of these, be on a panel talking about private equity, and hopefully we're being helpful. Yeah, I think it's very similar to what James said.
Yeah. So I agree. I will say that this panel in particular happens to work in a more hybrid environment. In traditional private equity, there might be more of a focus. So a number of my colleagues at larger firms, even large venture capital firms, they're not involved with so many of the activities. You might have portfolio operations as a department. You might have strategic relationships as a department where one person's just focused on making strategic introductions to the portfolio companies. And then you'll have perhaps a segmented investor group. And then within that, you might have individual target sectors. Each investor might have their own subject matter expertise. But I fall in that hybrid category where we do private equity deals. We have control buyouts. We also have the typical early stage venture deals in our portfolio. But James, I think, did a great job at outlining sort of these three buckets. So if you are in a venture capital space or in a hybrid hedge type environment or something in between venture and private equity, you have portfolio management. And James did a great job at providing the overview there. You have new deal development, and then you have the networking. In order to generate deals, you have to be out there meeting people and comfortable meeting people and just having an innate curiosity to learn about others and what they're doing. And I'm sure we'll talk about that later as well. And so those three buckets, I think, give you a good sense of what the day-to-day is like. And you do everything in a day. You might have more portfolio operations needs in 1 week, especially where you might be helping management hire new staff. You might be changing out management. There might be a major strategic initiative on marketing or distribution that you just really have to roll up your sleeves. And that especially comes around board meeting times. Other times it's like all new deal flow and you're diligencing deals and for that week, the portfolio is doing okay. So it's a mix.
I guess networking these days are happening all virtually, or at least in the last year.
I feel like it's coming back. Like over the past year and a half, a lot was done virtually, but I'm seeing more and more invites for in-person events. I'm not sure, Michael or James, if you're seeing the same, but I'd be curious to know.
I'm seeing like 1 or 2 meetings a week now that are in person.
Yeah, same. It's definitely a hybrid. There's really not as many conferences and large get-togethers that I've attended. They do exist though. There was an NFT conference just in New York the other day. But most of my work is certainly virtual right now. And when anybody is in town, I'm based in the Boston area. I'm happy to meet them for lunch, coffee, just to catch up. It is nice to be in person. It's a different experience.
Yeah, my office is also transitioning to coming back into in person, and it's such a better experience for everyone to work together. So I know that all three of you guys have been in this profession for a few years now. We'd love to hear about things that you love, things that really get you excited to go to work every day, and things that you if you could, want to improve.
Actually,
does it need someone? Oh, go for it, Michael.
Sure. I love the stimulation. Just to our previous topic, every day is different, and so I'm never bored, which is great. I also love to learn. I do have that innate curiosity. It's always been me since I was a kid, just asking lots of questions, perhaps like the little engineer in me that wants to understand how things work or what people are interested in. You learn about so many different topics, especially if you're in a generalist venture capital type of seat. I've learned more in the last 5 years being a full-time professional principal investor than I have in my entire adult life. And that's, I think, somewhat unique to venture capital and private equity, at least for a number of firms in the space. So it's the learning and the diligence and thinking strategically about these businesses, comparing them to the market. You have to be on your game, and I enjoy knowing that I'm surrounded by people who are much smarter than I am, and I learn from them. And this is one really wonderful perk about this space. There's a true subject matter expertise around every single corner, and you learn from them and you soak everything up. And there's nothing specifically that I would change. I mean, there's all sorts of small nuances within the industry and economic structures that we could get into, but that's a little bit in the weeds. I could just say that some of the things that are not as exciting and fun is when you're negotiating against a future partner, because it starts with discussing, how are you going to get we have a fiduciary to our LPs, to our investors, and we have to get the best deal. But at the same time, we need to nurture and build a relationship with the very partners who are going to generate those returns for our LPs. And it's a slightly uncomfortable. It can be fun, of course, to come up with what's a win-win for everybody. And so that's usually enjoyable. But when you're far apart and you still want a deal to happen, I don't think you can solve for that challenge, but that's one of the issues. And then, of course, there's a lot of administrative and legal. Larger firms will have those departments set up. You'll have your legal department and admin and finance. For smaller practices, like family offices or venture capital firms, you're doing it all. And so not only are you negotiating the deal, you're also making sure with legal counsel that all the details are there and it's all buttoned up. And I don't mind that. I somewhat enjoy the legal side of things, but that can get a little grueling.
I would echo all of that, though I will say, even when I was at Carlyle, we negotiated our own NDAs. It didn't change. But yeah, great minds think alike. I love to learn. I love to meet new people. I love to learn how companies work. I love to work with great operators, great management teams to think about how to make their companies better, take them from good to great. I will say, another thing that's great about private equity, and this isn't for everyone, but I think it's something we all find appealing, you're a principal, right? You're not a banker or a lawyer or accountant providing advisory services. That means in theory, you succeed, you hopefully succeed, hopefully don't fail, based on your investment decisions, which I think can be very exciting. Like the more you learn, the more you do, the more you will directly, hopefully benefit from that. I also, like Michael, love talking to smart people, learning about new opportunities, sharing ideas. Of course, if anybody has companies in mind, feel free to let me know. Happy to discuss. Yeah, why not? In terms of what can be improved, look, I mean, the hours are going to be unpredictable. That's the nature of the job. And obviously, diversity is top of mind in our industry, as it is fortunately, I think, in many industries, not just investing. I'd love to see more people of color in the profession, more women in the profession, and of course, more Yaleys in the profession.
Most important.
Yeah, important.
I agree with everything that's been said. This is a tremendously intellectually stimulating profession, both PE and VC. In particular, in my role, I just love working with early stage companies, and frankly, the earlier the better. I would say a majority of my investments to date have been in companies that are literally just 2 or 3 founders, like literally working out of a living room or a basement. There's just, at that stage, there's just so much opportunity to add value and bring best practices from other companies I've seen that were in those shoes, like, call it 3 to 5 years ago. Think from first principles about where the business should be going. There are no bad habits to unlearn, no inertia to overcome. Like, it's just a really fun stage to be investing in companies and supporting them. One thing that's not necessarily something to improve, but it's just the nature of our fund. We're a pretty young fund. We are on currently Fund 3, so we haven't been around that long, and it's a startup fund in many ways. So like we're figuring out the systems and processes now that will allow us to be sustainable for many decades to come and ensure institutional memory without, like stifling our creativity and individuality. So like, literally in the last few weeks, we've been revamping our investment memo writing process and formalizing our like voting thresholds, like checks below a certain size need X many votes, and checks above a certain size need Y votes, and all that stuff was very fluid as an early fund, but we're sort of institutionalizing it now, and there's some growing pains there.
Yeah. So I know we like touched upon this topic a little bit about, Elizabeth, you're talking about recruiting and how, in order to be in your space, ideally having 2 years of investment banking or consulting, background is probably like required. But, to make it a more broad perspective on this, not just in terms of, hard and soft skill set, but also thinking about, different characteristics. I know we talked about, you guys all enjoy intellectually stimulating environment, but also maybe certain things about like what kind of value you have or anything like that. From your experience, what kind of people are happy and really thrive in the career? And Elizabeth, let's start with you this time.
Yeah, sure. I mean, you heard what excites, the panelists here, myself included, about the profession. I think you also have to find those things exciting, one. And it's obviously, I think all Yaleys, I would hope, in my experience, they're excited to learn. They like intellectual opportunities. They're very curious. But in particular, you have to be interested in how companies work. You have to be fundamentally interested in investing, working with companies, and helping them to succeed. If you're not interested in that, this is not the profession for you. Just again, practically speaking, you have to be okay with traveling, sometimes with little warning. At least in my office, I was told one day, you're going to California later tonight. And it's like, okay, I have to go pack. And I ran to do that. That can happen. And then I was there for a week. I think it's very exciting, but that's also not for everyone. I mentioned this earlier, but you have to be okay with variable hours. I think deal-driven careers, that includes private equity, but also the advisors around private equity, they have to be okay with the fact that when things are slow, that's fine. But when you're busy on a deal, you can be working round the clock to get that deal done. So the hours that can clearly be unpredictable, and that's something you need to know going in. What makes it good for some people, myself included, is if you're working in teams, and so you're working around the clock, but you're with your colleagues. They're there with you. You're getting pizza at 2 a.m. Like being in school in some ways. But as a result, you have to like the people that you're working with. And I'm lucky at Stone Court. I have great colleagues. I love working with them. And when you're working long hours, that does make all the difference.
Yeah, I have to agree with you on the teamwork for sure. Even in the consulting, teamwork is so important, and having a great colleague makes such a difference when you're working on a study, on a project. James, let's go with you next.
Yeah, I think first of all, like just being smart is table stakes for any of these professions, right? So, but I'm assuming everyone here is smart. I think 3, like call it character traits that make someone thrive in both VC and PE would be curiosity, being a hustler, and then something like empathy or empathetic, right? So the reason I say those 3 things, like curiosity for sure, even though I'm at a vertical specific fund, I'm learning about new markets within that vertical or new business models, new technologies all the time. Like literally every deal that comes along, I have to learn something new. And so you have to enjoy that process of learning an area that you don't already know. Hustler, obviously, like you have to find and win deals by any means possible. Especially in today's environment, deals are incredibly competitive to win. And so like literally flying out and like meeting with them and talking about how you're going to add value to that company. And, in some cases like whining and dining the founder, like you have to be willing to do all these things to win these deals. And then of course, add value once you've invested in those companies. And then, empathy, like VC is fundamentally a relationships business. It's about the relationships with the founders, with the LPs, the co-investors. If you can't build those deep, authentic connections with those folks, then honestly, nothing else matters.
Yeah, James and Elizabeth hit on some really, really important pieces. Curiosity is huge. A willingness to work whenever and however to get the job done. It is not a 9 to 5 space, whether that's VC or PE. There are differences, though, I think, in both categories, in traditional private equity and traditional venture capital. Especially for venture capital, you need to have a decent degree of risk tolerance. It doesn't necessarily have to be risk tolerance about your own career. VC and PE both generally pay well, and there's a lot of upside. But you have to think with the mindset of taking sort of risk-adjusted bets. And tied to that, and that's shared with private equity as well, but there's more data, there's more information, so they're much more educated bets than in venture. But in both cases, in order to take those bets, you also have to be willing to have a view. It's not just about being smart and being curious, but you also have to arm yourself with enough information and then have conviction about that information, because you do have to take the leap. And it isn't until you take the leap and you sign on the dotted line and you get a deal done that you say, okay, now I'm ready. Because before that, you're still wondering, I'm not sure. And you're learning as much as you can, but you have to be able to take that leap and say, I have a view, I think this is a good bet, or I disagree with everyone, I think this is not a good bet. And there's rarely right and wrong. Sometimes there's more likely right and more likely wrong. But I will say that this industry, from what I've experienced, values points of view. And between that and the risk tolerance and the willingness to work whenever and just be curious, I think if you have those characteristics, you'd probably really enjoy either VC or PE.
I want to actually underscore this risk tolerance piece. I'm really glad you brought it up, Michael, because like when you talk to the folks who have incredibly long and successful tenures at the blue chip VC firms, like these are not the folks who are making like safe, consistent 3 to 5x return bets, right? You can build a fine career doing that, but you're not going to become like managing director of a firm. You have to be willing to take very, very uncomfortable, contrarian, like this thing could go to 0, or it could become 100x return for us. And those, like I said, those are like very uncomfortable decisions. And many folks at your firm are probably gonna be like, no, you're stupid, you're wrong. Like this is a terrible idea. And you have to be willing to get over that hump and take those bets.
And you have to be okay waiting a long time to find out if you're right. And sometimes you have to be okay doing all the right work and doing all the right analysis, and still something changes in a way nobody could have expected. And you have to be okay with that.
Like COVID.
Oh, yeah.
Investment memo 2 to 3 years ago. What?
Well, there's one other element to that, and it's also ego. A point of view that's not founded in facts and based on reality doesn't go very far, and you're not going to be long in the seat in the space. And it's one thing that I've learned and appreciated, that there's really not a lot of room for BS. If you're going to have a view, it's because you've done your homework and you've done your research. You don't just take out of thin air, I think this is going to happen, because there's going to be someone, as I mentioned, smarter than you around the corner saying, wait, but I've seen 3 of those things happen already, for you to say that could never happen. And so if you're not willing to say, hey, I'm going to have an informed view, but also I'm not going to stand on my high horse. If I'm wrong, I'm going to step back and say, that's a great point. I've learned from that and I'm moving on. I think that's a key characteristic, because this is a collaborative space. And I know that there's this, I think just a perception that finance in general is sort of hard hitting, and people are, from my experience, VC and PE is a very collaborative sector, and you are working with others and sharing ideas. You're not taking ownership of wins. You're sharing those wins, and you're accepting and taking responsibility for the views that you're wrong, and that's learning. And so I from my experience, I do think that's also an important piece of it, keeping the ego at the door.
That's a great point. And I would imagine that a lot of you guys dealing with private companies, you don't always have a lot of information, or I mean, I would think that rarely you have enough information to make that decision.
You never have enough.
Yeah.
You never have as much as you'd like. Yeah.
Right.
Yeah, I mean,
But it's all relative. Yeah. I mean, this is a private equity less so than venture capital. That's why Elizabeth had referenced the fact that if you're wrong in private equity, that's not very good. And of course, bad things happen all the time, and things that are outside of your control, and deals just don't work out the way you expect them to. But you have so much more information that generally you should be more right than you're wrong. Venture capital, you're right. You're really relying on limited information, limited track record. And possibly a team that hasn't done this 10 times before. Those are the best bets when you have a management team who has successfully navigated similar sectors and seen exits that were lucrative for everybody. But you still are doing your homework. You're understanding the competitive landscape and knowing what you don't know. And that's the biggest risk, is making decisions on things that you don't know, but that you could have known. And so while there is a big gap between a more mature business and a more mature industry, and a bet with an early company within a new thriving industry that's still writing the rules, there's a gap. But I don't think the gap is as large as most people think. There's a lot to learn, about a space, and you could be as detailed as doing market research surveys, right? Or you could just say, hey, I like that CEO founder, I'm going to take the bet. And different investors have different approaches. They're both fine. But there oftentimes is a lot of information you can gather in venture.
Yeah, I would just note in private equity, it's true often in venture as well, even though these are private companies where the information isn't publicly available, we'll negotiate an NDA, we'll send across a request list, and we'll get at least some of that information via that request list. So it's an exercise in prioritization, thinking about what are the key questions we need to be able to answer to make this investment. And then I think for all of us now, we're going to have to deal with the COVID question. Okay, were these earnings artificially inflated, or were they artificially hit? Is this sustainable? What's that going to look like? And again, nobody knows the future, but part of our job is to get the information we need and to take a view. And as has already been said, you never get all the information. So you just have to know what you need and make a bet.
Thank you guys for all the insight. I think this is very helpful. So, I think all of the folks on the panel, attending the panel today, are probably slightly at least interested in entering this career path. So, can you talk to us about, how do people usually get into this career path? Is there a standard hiring, like recruiting pipeline? Do you go into certain industry and then make a transition? I'm sure it varies by firm to firm, but if you can just give a general perspective on that, I think that'd be very helpful.
Yeah, I can start with the private equity piece if that's helpful. And I'd really like to make a Squid Game joke, but that might not be well received. That's not the actual process, to be clear. So in private equity, especially sort of big buyout private equity, in reality, preparation for recruiting starts very early. In fact, potentially too early. You want to get a banking or consulting internship. So that's something to start thinking about freshman, sophomore year even. And you want that for at least your junior year, which you can then turn into a full-time job offer. Then you do 2 years of banking or consulting, much more often 2 years of investment banking. And mega funds and some other sort of mid-market funds, so think like Carlyle, Blackstone, Apollo, KKR, TA, et cetera, they can begin interviewing bankers for private equity roles less than a few months on the job. So you graduate and you start interviewing in October. I've been on the other side of those interviews. You can tell the difference between somebody who went in prepared, like having done years of prep work, and somebody who hasn't. And that can make all the difference. And I will say, this is where kids from more pre-professional programs, like a Wharton, for example, may have an edge because this is what they've been doing in all of their courses for years. And I think, anybody who goes to Yale, you're smart enough to do this. You just have to know that this is the path you want to pursue and prepare early. Again, I'm not saying this is the required path. There are definitely other ways to get into the profession, but it is the standard path and the one with the greatest likelihood of success. So I just can't emphasize enough, just prepare early if this is what you want to do.
Elizabeth, can you actually also touch upon maybe people coming out of grad school? Do you have have you seen a pipeline for maybe like an MBA program, like Yale SOM or anything like that?
Sure. I will say, and this is not to be discouraging, but if you go to business school without a private equity background, it's much harder to get a job in private equity post-MBA. It is not impossible. I know people who have done it. It's just much harder because you're also competing against people who've done private equity before, have the experience, and have the references. So I would recommend, and this is just one point of view, as we said, we all need to take a view in many scenarios, investing included. If you're in an MBA program and want to get into private equity and don't have that experience, I would recommend doing an internship. That's a way to get references, to get reps, and that can help get your foot in the door. Whereas again, if you're competing against people who have that experience, it's much harder. And there are a lot of people in business school who want to get into private equity, don't have the experience, and then they may also go into banking or consulting and then try and get in. That's also a challenge. It can be done, but again, I think some sort of internship can really add a lot of value.
Great.
Yeah, private equity has perhaps a slightly different traditional path than venture capital, but there are many different ways that you can get into both spaces. I've enjoyed getting to meet so many other fellow investors, and their stories are pretty diverse as to how they landed in the seat they landed in. And I will say that I never had an appreciation for the investment banking education, and I only appreciate that sort of now when we do hire and we speak with folks. And it's not about, and I'm certainly not looking to be an advertisement for an investment bank, but it seems that there is a skill set around understanding how to research businesses, how to research industries, and you take that thought process, just like law school. You go to law school not necessarily to memorize the Constitution, but to know how to think and how to apply the law in the future, and how to find the answers to your questions. That's just one benefit of investment banking. That's not the direction I came from. I actually came in as an operator. I spent most of my career as an entrepreneur, starting businesses, working in all sorts of size businesses in very entrepreneurial capacities, building departments, trying to think strategically. I did go to business school specifically so that I could fine-tune my finance chops and have at least that education that I did not get that my investment banking peers did. Because frankly, the investment bankers in my MBA program, they were way ahead on at least the finance side of things, but perhaps not so much on the operations. So I don't want to speak to private equity, because even though we do private equity, we are not a traditional shop, and that's not my area of expertise. VC is quite a mixed bag, and you can come from the investment banking space, but I do see a lot of operators who are successful partners in various firms where they have either started, sold, worked in emerging businesses. They really understand how to connect with founders from that perspective, and that's really where I come from. And there's a lot more of us out there than I had expected. But I do think that the finance track is more typical for the traditional venture capitalist, where you have a way of thinking about business and industry. So I'll leave it at that and let James jump in.
Yeah, so as I mentioned, I'm in early stage, and I might have had an answer for this like 18 months ago, or like 24 months ago, that was different. The lines are starting to blur because like the late stage folks, the crossover folks, even some of the hedge funds are starting to do early stage. And of course, most of those folks come from traditional banking and PE backgrounds. But early stage truly is like a cottage industry. It's, to Michael's point, the closest thing to typical path is being an operator. So having founded companies or worked in tech companies and then pivoting to VC. But lots and lots of other paths, banking, consulting, folks who went from later stage to earlier stage. I have an unusual path of having worked in the end market, so to speak. Like I was an educator, I worked in public sector, nonprofit sector. I was like the person that these companies are trying to sell to. And so I had a customer appreciation from that perspective. And that's what's allowed me to succeed in this role. And then a small but substantial minority of early stage VCs are actually career VCs who have never done anything else. And there are a handful who have actually been very successful with that career path. So yeah, it's hard to say what's typical in early stage.
Just adding on to that question, I think this one may be useful for some of the folks thinking more long-term in terms of career. Can you guys also walk us through, I know that there's no really word typical apply for everything, but if there is a typical career path, let's say, for example, for consulting, you come in as business analyst 2 years. Every 2 years, you get promoted, and maybe you will spend as short as 8 years up until you make a partner. Can you talk us through some of the typical, more of the position change, the role change that could happen? And any takers, Michael or Elizabeth?
Well, Elizabeth has a good perspective on the traditional private equity, so I'll let her. I think she did touch on that 2-year investment banking period. Then you hopefully get recruited into PE. Maybe Elizabeth, do you have more thoughts on that?
Yeah, no, I mean, I'm happy to talk about that more. So speaking for like the traditional PE track, so yeah, 2 years of banking or consulting, more often banking, either one is possible. 2 years in an associate role, and then some private equity firms will require that you go to business school. Some don't, and so that's something that a lot of people think about when choosing what private equity firm to go to the extent they can decide. Either way, post MBA or after the associate role, you could be a senior associate or a VP. The titles change at different firms, but basically as an associate, you tend to be more focused on building models, on putting together presentations. Again, this can change. In some firms, you do more sourcing, but again, in general, talking about sort of the mega funds, the standard LBO shops, you're not doing as much sourcing. You're really focused on putting together materials, doing a lot of data analysis. You spend a lot of time in Excel and PowerPoint. And then as you get more senior, I think you do more sourcing, more high-level strategic thinking over time, spending much more time interacting with management teams and operators. And you do more of that just as you progress up the chain. So in terms of how quickly you get promoted, at what point do you reach managing director or partner level, that varies from firm to firm. But that's sort of the general way your career progresses within a standard private equity firm.
And I can speak a little bit to venture capital. James is a great example. And I think I fall in a similar category where my point of view comes from some level of subject matter expertise. For me, it's in consumer, retail, food and beverage, as well as apparel. But then within that role, because I ran a restaurant business for 7 years, I spent a lot of time on technology and understanding the landscape. And I find more and more people that I interact with in the VC world, they happen to have that expertise in the field that they invest in. And you can expand that. And I'm lucky to be in an investment practice where we're somewhat sector agnostic, and we take all sorts of interesting bets, and we learn about insurtech or prop tech, fintech, which might not be directly related to what I did. But the reason that I'm in the role that I'm in is because the need was for expertise around consumer. And James's background, and I don't want to speak for him, but his education. And there are certainly folks in venture capital who did the 2 years of investment banking, and then they came into an opportunity at a VC, or they also, maybe they were investment banking, consulting, they worked for a couple of companies, went to business school and decided they wanted to now move into venture capital. There's a lot of people who had not done VC prior to their MBA, but it's certainly not a requirement. It's certainly helpful because that's where you can network and get to take a step back in your career and think of the next steps. But VC definitely, more so than not, tends to have people who have experience in the spaces that they invest in, because you are taking those bets earlier on, and you can't rely on spreadsheets and that education in investment banking. You kind of have to have a view of the overall space because you were in it. You spent a lot of time with others in it, and you can ideally make a bet better than your peers who don't have that same expertise and experience.
I'll go back to this original question, Julie, of the typical career path. So I see it as kind of two phases. There's the junior sort of analyst, associate, senior associate, VP, principal track, which it's a little bit more idiosyncratic firm to firm. Basically, if you do a good enough job, you'll probably make your way up that hierarchy. I think where there's a big winnowing and a fairly standard criteria for going from principal to partner. And the reason why is because when you make that jump, you start getting substantial carried interest in the firm in most situations. And that carried interest pool, it's basically a share of the firm's profits. It's by definition fixed, right? It's like 20 or 25% of the profits typically. And so adding another partner means there's more mouths to feed at that top level. I'm getting into the sausage making here. I hope it's appreciated. But you basically have to prove as a partner that as a partner, you would expand the pie more than you'd be taking your little piece of it, right, as a partner. And so it's not just enough to be good at executing and creating deliverables and doing the work that other partners are giving you. Like, you have to be creating value for the firm. You have to be sourcing, picking, and winning incredible deals, and probably should be bringing limited partners at that point, at least to some extent. So that's sort of like where the lead to partner happens.
This is all great. I know we have 10 minutes left. I'm gonna actually jump to the last question and wrap this up. So if you can give, as a fellow Yalie, if you can give a piece of advice to the Yalees attending this or who may watch this video afterwards, planning to enter the profession that you're in, what should they really know beforehand? And I know it might be repetitive, but if you could pick one piece of advice.
I'll take a stab at it. I'll say first, I feel very fortunate to have found an opportunity in venture capital and private equity. These are coveted roles. There are not many of them relative to the amount of interest for all sorts of reasons that some are obvious, some perhaps not. So I think just understanding that a lot of luck and a lot of tenacity is required to just get there. Assuming the table stakes, you've passed that point, right? You're smart, you're hungry, you're curious, you have a view, you get along well with others, you have both IQ and EQ. There's a lot of people who fit in that, that bucket, a lot, right? We all go to Yale. Everyone on this call probably, matches those criteria. But you have to be hungry for it, and you have to be willing to talk to as many people as you can and be patient. And if you don't land where you want to land, figure out what you're passionate about. Do that for a while, whether it's in any area, biotech or education or consumer or fintech. Get a job, work in an early stage company, run the reps and earn your stripes, and then try again. It's not for the faint of heart, the process. And sometimes you might be lucky. You'll get picked right out of college to go to that great investment bank. You'll get picked right out of that investment bank. But you're competing with a whole bunch of other people at that same level. So I would just say you need to be willing to put yourself out there and learn and meet with people and give yourself the opportunity so that hopefully the luck lines up with that approach.
I'll give a somewhat unusual piece of advice. If you're thinking about early stage VC, I mean like early stage, like seed and series A, like we do, don't do it for the compensation. Comp trajectory in early stage is actually very unattractive relative to other finance roles until like well into your career path. And even then it's mostly from the carry, not from the actual cash comp. So if you want to do early stage, you should do it because you actually love the work, right? The hustle and the grind of sourcing and picking and winning deals, like sticking with your founders for the long haul. If you enjoy that work like I do, I'm not going to say the comp doesn't matter, but the fact that it's not as attractive in the early days is not as important because the work is so fulfilling itself.
I guess two pieces of advice. First, as you can perhaps already see from this discussion, venture capital and private equity come in many different flavors. Even standard large cap private equity comes in many different flavors. And you could do growth, distressed, they're sector focused. These are all very different. And don't go on the message boards. Don't go on Wall Street Oasis or whatever the new message board are using these days. You have to think about the type of investing that's right for you. Some people say, I have to go to a mega fund that's prestigious. Some people say they have to go to the top distress shop. Really think about how you're going to be spending your day, what excites you, who do you want to work with? And that's really what matters, not like the ranking of the firm that you're looking at. And then second, I think this has already been said, but just it's worth repeating, make use of all of the resources at your disposal. I guess you're already doing some of that by attending this panel, but you have to be willing to knock on doors, talk to a number of people, ask for advice. You never know what door you're going to knock on that's going to be the door that will get you the opportunity you need. And on that note, if I can be helpful, please let me know, reach out on LinkedIn. I'm always happy to chat.
These are all really great advice. I wish I knew this advice before when I was in Yale too. Okay, so we have 6 minutes left. I'm gonna check some of the Q&A here and chat. Okay, let's see. One question here. Is there a market for PhDs at VC firms? James or Michael, you want to take that?
Not at our firm or within our space more broadly, that is at tech, but I definitely know that PhDs are in high demand for like deep tech VCs or like science heavy, certainly biotech and healthcare. So there is room for them, just not in my particular vertical.
Yeah, that's right. That's right. In healthcare, biotech, you see a lot more of that there. In generalist sectors, it's not as common. At least I haven't. It's anecdotal. Perhaps it's more common than we realize, but I don't see it as much.
Okay. And then another question here is, are skills developed from investing in public markets with a deep industry focus applicable to VC or private equity? Maybe Elizabeth, you want to take that question?
Yeah, sure. I would say, of course, as we discussed earlier, this profession is all about understanding how companies work. So at least from a private equity standpoint, I would think applicable to venture as well. If you spent a lot of time at a hedge fund or looking at the public markets, and you have especially deep sector knowledge, that can certainly be useful for private equity. There are other skills you'll need to develop for private equity, like the in-depth technical modeling that's a little different in private equity versus what you might do in the public markets. But I mean, we work with colleagues in the public markets all the time. We have a SPAC. We do some things that are crossover deals, late stage private equity investing that with the anticipation that the opportunity will go public in the near future. So I would say certainly yes, those skills are very relevant.
Yeah, the hard skills are definitely, I think, more applicable in private equity transactions than they would be to venture capital because you're not working with as much data. But a big part of looking at public equities is also understanding management teams and the way that they function and work. And that's actually a really important piece of VC because you're measuring and evaluating the management team on very similar merits. You're looking for these A players, both in VC as you are in public equities, to underwrite certain bets there. I don't want to go too far and make presumptions because I'm not a public equity investor, but from the folks I know, that is a piece of it. So yeah, it is helpful.
Yeah, I will say even in early stage, so we're certainly not getting like the GAAP compliant 3 financial statements from our companies. They're not even close to that. But we are in the course of our work, like reviewing relevant S1s from companies in EdTech going public, for example. We're reviewing their 10Ks and things like that. And having literacy for that kind of information is really helpful, even doing early stage investing.
Yeah. Okay, just one more question here. Can you talk a bit more about sourcing deals? How did you start build up the connections? James, actually, can you take that first? I think.
Sure. Gosh, I mean, in the early days, it's like whatever the heck I could get, right? It's like going to all the conferences, cold emailing any founder or investor in this space. I had the fortune that when I joined Reach, we have like an open type form on our website where anyone can submit a business plan, and I was responsible for reviewing all of those, so I got to see a lot of cold inbound deal flow. But yeah, it's frankly it's a ton of hustle in the early days, whatever you can get. Over time, as you build a reputation for your vertical and for whatever stage you invest in, people start reaching out to you. So like co-investors now all the time will reach out when they see something in, say, like corporate L&D, because they know that I do that, right? So seed and Series A deals in that space. The other thing that people have varying opinions on, I like doing thought leadership. So I'll from time to time write articles that we'll publish on our own blog or that'll go on TechCrunch or wherever else. And that way I'm sort of establishing my credibility within my vertical, within my space. And that's a way to sort of funnel founders towards me.
Michael or Elizabeth, do you guys want to take that?
Yeah, sure. So I would break up deal sourcing into two buckets: inbound and outbound. You know, to James's point, early on, you're doing everything you can to network with other folks who may see deals within your sector or area of interest, and you're going to conferences, you're reaching out to people, you're asking for introductions, you're making it clear that you're in business here and you're looking for deals of XYZ shape and size. I will say though, when I speak with other investors, where do they get the best deal flow? It typically comes from outbound deals. It's identifying, either coming up with a thesis and then going after all the companies that sort of match that thesis and trying to find who's the best one. And also hopefully the best one is willing to take your capital, or willing to be acquired in a private equity transaction buyout scenario. But a lot of reading, especially for your sector, and that's why you will see a lot of VCs do tend to focus in certain areas because they get very good at what they're doing, and they typically know everyone in the space because of both that inbound, but largely because of the outbound, and they know what they want. So that's high level. I'm sure Elizabeth has an insightful view to this as well.
Oh God, no pressure. No, I mean, I think I agree with a lot of what's been said, especially if you have a sector focus and you have a really good sense of where a particular space is going. You can become sought after as an additional viewpoint by operators in the space. If you go to enough conferences, if you read enough, if you talk to enough management teams, you have a credibility in that area that I think just an investor who hasn't spent the time does not bring to the table, and management teams in turn will want to work with you. I will also say, when you have portfolio companies in a space, you become an expert in that space. I spent a lot of time with a company in the radiology space, and I was able to talk to anyone at the various radiology or healthcare conferences, and you know what's going on because you're embedded in that space through your work with that portfolio company, and that can also be a great source of leads as well.
Yeah, sort of on, you touched on kind of reputation. The way I view this sector, both private equity and venture capital, is that reputation is your currency. And oftentimes you can cash in on that currency when your reputation precedes you as a great partner to the companies that you invest in. We've seen a lot of fantastic deal flow from the CEOs in our portfolio because of how they were treated with us. And when they're asked, because founders are constantly talking, and management teams are constantly talking to each other. Who do you know? I'm looking to fundraise. And if you're not top of mind, you're not going to see the best deals. And so being very mindful about how you treat your partners goes a long way to securing the best deal flow.
Thinking about long-term as well. Okay, so I think we are out of time. Thanks again to Michael, James, Elizabeth for taking the time to share your view today. I'm sure this was very helpful for all the Yalees who attended tonight. For the attendees, if you click on go to the lounge, you should be able to enter the ballroom. It's a virtual ballroom where you can select a seat and then start networking. Thank you, everyone.
Yeah, thank you.
Thank you.